Welcome to this financial modeling podcast training session. Today, we're diving into an essential concept in project finance, debt sculpting. Whether you're new to the field or looking to refine your skills, understanding debt sculpting is critical for structuring effective project finance deals. So what exactly is debt sculpting? In project finance, debt sculpting refers to the process of aligning debt repayment schedules with the project's expected cash flows. Essentially, you structure the loan repayments so that they match the project's ability to generate revenue, ensure that the debt can be serviced smoothly without straining the project's finances. In traditional loan structures, repayments are often fixed, regardless of a project's cash flow fluctuations. With debt sculpting, repayments increase or decrease based on how much cash the project is generating at any given time. This allows for greater flexibility, especially in the early years when cash flows may be lower. Debt sculpting has several key benefits. First, it optimizes cash flow by aligning debt repayments with the project's revenue. Second, it reduces financial strain during the early stages of the project when revenues might not be fully realized. Third, it increases the project's financial viability and attractiveness to lenders, as the risk of default is minimized when payments are tailored to revenue. Now, let's walk through a simplified example of how debt sculpting works in practice. First, we forecast the project's cash flows over its operational life. This will include revenue projections from the project's output, such as toll revenue from a road or electricity sales from a renewable energy plant. As you can see, for this project, the revenue is not linear. We can see that the utilization of this plant changes over time, and therefore revenue sometimes dips in certain years and goes back up. In a normal debt profile, the total repayment is the same every year, 5.6 million in this example. 5.6 million, and you can see that the debt amortizes normally over 9 years. However, if for example this project had a target debt service cover ratio of 1.8 times, that means that the total repayment would equal the net revenue of the project for that year divided by the debt service cover ratio. We can see when we have a look at that over the project life that in certain years the revenue might decrease. Therefore, if we want the principal paid to be sculpted, we can see that might change over various years. And the debt balance instead look like this, where the debt balance is reduced more in years where the revenue is higher. So, to recap, debt sculpting is a powerful tool in project finance that allows you to structure debt repayments based on a project's cash flow. By aligning repayments with revenue, you can optimize cash flow, reduce risk, and increase the likelihood of securing financing. For more insights on project finance and financial modeling, make sure to subscribe to the Financial Modeling Podcast. We'll see you again in the next video.